What if you could predict your financial future? Well, there's a number that comes pretty close. It's a concept that you hear in the news probably every week, but there are some consequences of it that you might never have thought of before. By understanding this concept and how policymakers react, you can shape your finances. And I'm going to show you how this single metric can help you make smarter money moves, from investing to timing your house purchase to negotiating your next raise. Hi, I'm Aisha, your friendly neighbourhood economist with over 10 years of experience and a master's in economics and finance. Okay, let's get to it. Picture your country as the world's biggest food court. If I asked you how big a cake is, you might tell me its weight, its diameter, or how many people it feeds. All valid ways to measure the same cake. Think of GDP or gross domestic product like weighing a cake. You could weigh all the ingredients going in, you could weigh the finished cake, known as the output method, or you could count how much money you made selling slices. That's known as the income method. Now, all methods should get you to roughly the same figure, but we'll focus on the output approach to GDP, as it's the most direct way to understand what's happening in our economic food court. Okay, imagine having to calculate the value of every single activity taking place. In the kitchen, we're counting every meal being cooked, from the morning breakfast rush of fresh pastries and coffee to the lunchtime stir fries and evening dinner services. This is what we call production, the heart of our food court's output. Then there's all the service happening on the floor. Servers taking orders, cleaners maintaining the space, security keeping everyone safe, and managers coordinating it all. These essential services keep our food court running smoothly. We also need to count all the investment happening in our food court, from new pizza ovens and refrigerators to renovated counters and updated payment systems. These improvements add long-term value to our food court's economy. Finally, we're tracking everything moving in and out, from fresh ingredients arriving to catering orders going out and delivery drivers connecting our food court to the wider community. When we add up all these different activities over a specific time period, that gives us our food court's GDP. It's the total value of everything being produced and served up in that food court. Now, just like a food court gets busier or quieter depending on various factors, GDP goes up and down too. And just as a busy food court usually means good news for everyone working there, from the chef to the cleaner, growing GDP typically means good news for people's wallets. So we've covered the theory, but the theory can be quite abstract. So how does this actually affect you in your everyday life? Let's talk about job opportunities first. When GDP is growing, it's like our food court during a massive boom. Think about it. When more customers are coming in and spending money, everything starts happening. The busy noodle stand needs to hire more chefs to keep up the orders. Even the bubble tea shop is offering higher wages to make sure the best servers don't get hired by competitors. It's like a busy dinner service that never ends. When one stall does well, they all start doing better. The sandwich shop sees the success of the noodle stand and thinks we could do that too, so they expand their menu and hire more staff. The cleaning company needs more workers to maintain all these busy stalls. Even the delivery services start hiring more drivers. And here's the really interesting part. It's not just about more jobs, but better paying ones too. Imagine you're an experienced chef. When every restaurant in the food court is desperate for good staff, they start competing for talent. Suddenly, you might get offered better wages, more benefits, maybe even a chance to manage your own kitchen. This is exactly what happens in the wider economy when GDP is growing. But instead of just restaurants, it's happening across all types of businesses, from shops to offices to factories. This is no different to you in the real world. If GDP is growing and businesses are confident and growing with it, then your wages and job prospects are likely to improve. And if you do manage to get a wage increase or promotion, instead of being tempted to spend more on material items, this could be a great time to put it towards any other outstanding debts you might have. It might also be an opportunity to invest in shares or maybe a business idea you've had. So we've identified the positives of GDP growth, but what are the side effects of this growth? And how might this affect your financial decisions? Let's talk about how GDP growth affects interest rates. It's a fascinating relationship that directly impacts your money. When the economy is growing strongly, the Bank of England often raises interest rates to help keep inflation under control. It's a bit like adjusting the temperature on your thermostat. Small changes help maintain balance in the economy. These interest rate changes affect pretty much every aspect of borrowing and saving. If you have a variable rate mortgage or you're looking to get a new one, higher rates mean larger monthly payments. The same goes for other types of loans. Whether you're thinking about financing a car or taking out a personal loan, the cost of borrowing increases. But there is a silver lining. If your mortgage is rising and you've managed to secure a wage increase or get yourself a higher paying job, this is a great time to put more money towards your mortgage. Making overpayments while rates are high could reduce your overall interest costs. And when interest rates rise, saving accounts typically start offering better returns. If there's been a period of ultra low rates where savings barely grew, higher rates mean your emergency fund or regular savings could finally earn more meaningful interest. If you've saved your emergency fund, there might be some good high interest rate savings accounts you can put that in. It might be easy to be positive about GDP growth, but there's also a lot of negativity in the news about slow GDP growth or recessions. When there are these downturns, it can be difficult for a number of people, and we don't want to belittle that. However, there can be opportunities in these times as well. So let's take a look at what actually happens when our food court gets quieter. When fewer customers are coming through the doors, everyone starts behaving differently. The lunch rush isn't so rushed anymore. You might notice servers keeping their tips rather than spending them at other stalls during their breaks. The food stall owners start thinking about how to protect their businesses too. Some might reduce their opening hours. That chef who was thinking about buying new equipment for his kitchen, well, he's decided to make that old stove last a bit longer. Most will be extra careful about managing their inventory. Even the customers who are still coming in are being more careful, maybe ordering the regular bowl instead of the large one, skipping the extra toppings, or sharing a dessert instead of getting one each. It's like everyone in the food court is collectively holding their breath, watching their spending and focusing on building their safety net. That's exactly what happens in the broader economy during slower periods. People and businesses become more cautious with their money, focusing on security rather than expansion. But here's something fascinating about quieter times in our economic food court. They can create some unexpected opportunities for people who know where to look. Think about it this way. When the food court is less busy, the property manager might offer better rental deals to keep their stores occupied. In the real economy, this shows up as lower interest rates, which could mean cheaper mortgage payments if you're a homeowner, or a great time to get on the property ladder if you've been saving for your first home. And just like how a quieter period gives the best chefs time to experiment with new recipes or perfect their skills, economic slowdowns can be the perfect moment to level up your career through additional training or education. Many people have used these periods to start their own businesses too. Right, we've looked at the internal effects of GDP to a country, but how does it affect you and your finances once international effects of GDP are taken into account? Imagine our food court is actually competing with food courts in other countries. when our food court is doing really well compared to others, serving more customers, selling more meals, opening more stores, something interesting happens. It's like our food court's gift cards become more valuable at other food courts around the world. Think about it this way. Let's say you have a £10 food court voucher. When our food court is thriving, that same £10 voucher might get you €12 worth of food at a Spanish food court instead of just €10. Let's explore why this happens. Imagine food courts around the world are like trading partners. When our food court becomes super successful, more people want to eat here. Other food courts want to open branches in our location. International suppliers are eager to sell their ingredients to our stores. International investors want to buy shares in our successful food court. All this interest in our food court makes our vouchers more valuable. It's basic supply and demand. It's like when a new trendy restaurant opens and everyone wants a reservation. The more people want in, the more valuable those reservations become. So, when our food court is thriving, international suppliers and investors need our vouchers to do business with us. This increased demand for our vouchers makes them more valuable. Now, your £10 voucher might exchange for €12 instead of just €10. This means you can buy more with the same amount. Okay, let's see this in action at our international food court. Before, your £10 voucher would buy you €10 worth of ingredients. A bottle of Italian olive oil costs €5, so it takes £5 of your voucher to buy it. After, when our food court is thriving, your £10 voucher now buys you €12 worth of ingredients. That same €5 bottle of olive oil now only costs about £4.20. You're getting the same product, but for less money. So, what does this all mean for your day-to-day life? When our currency is stronger, your holiday spending money goes further. That weekend in Barcelona or summer break in Greece becomes more affordable. Have you noticed how the price of petrol at the petrol station changes when the pound strengthens or weakens against the dollar? That's because oil is priced in dollars globally. Filling up your car might cost less. Tech gadgets often become cheaper as most are manufactured overseas. These effects ripple through to many everyday purchases you might not even realise are imported. So, next time you hear GDP mentioned in the news, remember, it's not just some abstract number. It's a powerful predictor of your job prospects, interest rates, and even how far your money goes abroad.